so my base case for a while, the kind of the call that I've been making for the past, couple years, is that I expect the 2020s to be a pretty inflationary decade. Now, hyperinflation has not been my base case in developed markets, but I don't rule it out as a possibility. In general, it's hard for inflation to exceed the money supply growth for a long period of time. That's kind of the core of where price inflation comes from, is the amount of money in the system going up. And so in the United States, for example, over the past year, the money supply is growing at about 13% year over year. That's lower than it was in 2020 when you had that gigantic spike, but it's still at above normal levels. In the UK, you're looking at a little bit lower than that, but still somewhat elevated growth levels. And so that doesn't represent like a near term ceiling, but it's hard to have say CPI go above that for a long period of time. And so you can also look at, say, producer price index. And so, if you look at producer prices going up in the United States, somewhere around 8%. So that, if that were to persist for a while, you could see CPI continue to elevate. And so there's a couple key things to watch as far as that's concerned. We also can go back to if central banks try to tighten and try to kind of, kill some of the demand, that could kind of temporarily alleviate inflation, but then they start that economic stagnation cycle, and then they probably get into another stimulus cycle. So long term, it'll really come down to money supply growth. How much kind of fiscal deficits happen that are then monetized in part by the central banks of the world. Over the long run, you can look at that broad money supply growth, and then you can look at CPI growth. And there are some areas where you get pretty high divergence. And so, for example, in say the late 1800s United States, you had pretty rapid money supply growth, but as a deflationary period. And that's because we had all this land that we were expanding into. Obviously, the natives, but that's a whole nother story of history. So there's all this land they were expanding to. They found oil. They invented the internal combustion engine. They electrified things. And so between the Industrial Revolution of the UK and then all this expansionary land in the US, you had prices be very, very low because you had massive productivity gains, railroads, things like that. And then similarly in the 90s and the 2000s, we've had another decoupling from broad money supply growth and inflation, and part of that's from globalization. So wage pressures have not kept up with money supply growth in especially in the United States, but also in some other developed countries, and that's in part because all that all that extra wage pressure, instead the release valve ends up being either in some cases automation, or especially for the United States and others like outsourcing. So the combination of the growth of the internet, growth of offshoring, has been a very kind of disinflationary generation. But there's signs that that's kind of topping out. We've seen in 2020, 2021, if you have an extremely globalized supply chain, how fragile it can be. We basically sacrificed resiliency in order to make it as efficient as possible. And we're maybe finding out that was the wrong balance. We went too far in favor of efficiency and less towards resilience. And so I think now there's kind of a bounce back towards resilience. We also, of course, have growing tensions between the United States and China. And so I think that basically this accelerated period of globalization is probably behind us. And so adding to the commodity scarcity, this kind of flatlining or even partially reversing globalization is another inflationary pressure to be aware of. Historically, hyperinflations tend to happen. There's kind of two big ingredients that go into making hyperinflations happen. So one is some sort of damage to your productive systems. So that can include, for example, in Zimbabwe, they reorganized how they do farming. There's basically social conflict there. That's a very long story, but you had a production collapse, and of course Weimar Germany after World War I. I mean, they were impaired in terms of the damage they sustained from the war and the economic consequences of that. The other big kind of ingredient is when you have liabilities denominated in an asset that you can't print. So in developed markets, they have a lot of debt, but it's in their own currency, and so it's somewhat easier to kind of quote unquote taper Ponzi. You can kind of do that kind of over time. Whereas if you're an emerging market and if you say you owe dollars, right? There's no way that your country can create dollars other than earn them through trade, and so you can pretty easily run into default scenarios and currency collapses. generally in developed markets today, we don't directly see like kind of the ingredients of hyperinflation. But so my base case for a while, the kind of the call that I've been making for the past couple years is that I expect the 2020s to be a pretty inflationary decade. Now, hyperinflation's not been my base case in developed markets, but I don't rule it out as a possibility because after a certain point, if people lose confidence in the system, if they don't want to buy the bonds, and if you start to see kind of a out of control kind of deficit monetization, then anything is possible. And so, especially when you combine that with energy scarcity or deglobalization or potentially any sort of black swan event that could occur, like a natural disaster, the high inflation of Turkey and Argentina is not necessarily considered hyperinflation. Whereas, for example, obviously the Weimar Republic was a hyperinflation,
Hmm.
Zimbabwe was hyperinflation. I believe Venezuela classified for long periods of time as hyperinflation. But above a certain point, it almost doesn't matter too much. I mean, obviously there's a difference between,
Mm.
say, 25% inflation in Turkey versus, say, 1,000,000% inflation in Venezuela. There's a difference there. But once you start getting into double digits, inflation becomes a very obviously a major issue in any market. When commodities are super cheap and you can't really make money by building new mines, it's too risky. It's just not really profitable. There's not a lot of new capital comes into the space, so no one really builds new supply. And eventually, after a long enough time, I mean, the existing mines get drawn down. They don't put new money into expanding them, and demand usually keeps ticking up over time. And so eventually, that excess supply works itself off, and you start to get actual scarcity, and that drives the price up. And then because those mines often take years to bring online, it's not like an immediate function. It's not like they can just snap their fingers and make more copper. And so you usually go through this period where copper prices, for example, are very, very elevated, and that gets worse and worse until it keeps attracting more and more capital to come in and find and build new copper mines to eventually alleviate that and kind of start that cycle over again. So that ends up being a very long-term capex cycle. One of the issues is recency bias. So investors and policymakers look back over the past, say, 5 years, 10 years, and say, energy is abundant. We have nothing to worry about. We don't have to keep investing in it aggressively. But the problem is that by doing that, it becomes self-fulfilling, where we eventually have, basically a commodity surge where we've underinvested in a lot of these things. And then if we still are kind of in the mindset where we're not going to invest in them, that they prices can get pretty high and persist for a while. I mean, it might not be a straight line. Some of these parabolic spikes, especially what we're seeing in Europe, might cool off at some points. But I think that this is going to be a big story for the 2020s, where we've not brought a lot of new energy supplies to market over the past 5 years.